Hello, hi. Hope you all are doing good. Today I have come up with a video from subject accountancy, class 11th. Topic is Indian accounting standards, one of the very basic and important topic. Before we start the video or this lecture, please do subscribe the channel and share the videos. If any suggestions is there, opinions is there, do comment. Remember guys, this channel I Study Commerce is for you. So any changes, any addition you want, please do comment. So let's start the topic, Indian accounting standard. See, it's important reason because all the chapters which you will be learning following this first session, following this first basic chapter, every other chapter, every practical part means where numericals are included, they follow certain rules and regulations and norms. Okay, so these rules and regulations and norms are being prescribed in Indian accounting standards. Here Indian accounting standards speaks about all the rules and regulations that you have to put and follow while solving any problem, based on any of the topic coming in accountancy subject. So first we'll get into the meaning and nature of accountancy. So as you can see here, accounting principles are the norms or rules which are followed in accounting of various items of assets, liabilities, expense and incomes. So in short, if I say accounting principle speaks about the rules and regulations, and those rules and regulations applied on assets, liabilities, expense and incomes. These are the very important elements in accountancy. Now this accountancy principle has been classified into two categories, or you say the two major subdivisions: accounting concepts and accounting conventions. So concepts speaks about the rules on which the transactions are recorded, and financial statements are prepared. Here I have used two technical terminology: transactions and financial statements. So let's understand what is a transaction. Transaction is something, it's an agreement between two parties. Now here the two parties is a buyer and a seller. So whatever the transactions or whatever the agreement took place, it's a you understand in simple language, it is a piece of a business that takes place between seller and buyer. So in business comes trading. Trading means selling and buying. So transaction is that trading part. It's a piece of a business, or it's an agreement between buyer and seller. That is a transactions. And financial statements is something that gives the actual position of a business. It is being evaluated based on profit and loss account, trading and profit and loss account, and balance sheet. These two statements, the financial statements has been classified to understand the actual position of a business, where our business stands, to understand the profit and loss, whether after operating for a year, how much profit or loss the business has incurred, and based on that, what is the value of assets and the liabilities on a particular date. Then comes the accounting conventions. So you see here, accounting convention is something which keeps on changing with the time. Okay, it may happen that during 1980s, some of the just take an example, some pattern or some method of depreciation had been charged, but by the changes in the time, with the changes in the time and with the changes in the technology, trends, demand, maybe conventions have been changed based on the need of the time. Certain applicability of any rules may have changed. So those accounting conventions, they undergo the changes based on the need of the time. Then you see here, next, fundamental accounting assumptions and concepts. So here we will be discussing what are the accounting assumptions. Now assumptions is something that we assume that to implement all these rules and regulations of accountancy, certain assumptions are taken. Certain cases or certain situations are, by default it is understood ki these eligibilities or these requirements will be fulfilled. So this is assumption, fundamental accounting assumption. Accounting rules are made, but they are based on certain assumptions. Assumptions are something that has been taken as a default. These certain cases will always be there no matter what. So we'll see here one by one. First, as you can see, is the going concern assumptions, then consistency assumptions, and third is accrual assumptions. So I'll give you an example for going concern assumptions. It is said that business will continue for a foreseeable future. The foreseeable here means that it is going to stay, it is going to sustain for a longer time. We have established business with a thing in mind, with an object in mind, with aspirations in mind that business will continue, it will keep on expanding and growing. We usually do not start a business that is we are going to end it by the year end. No one does that. So this is a going concern that business is going to sustain over a long period of time. Then comes the consistency means that you follow a trend year by year equally, same, without any change. So consistency assumptions based on the, if I take an example of a depreciation calculation, right? Depreciation is the wear and tear of the value of assets. When the value of assets reduced, the reason could be wear and tear, obsolescence, or whatever. So as per the accounting rules, depreciation can be calculated on by 4 to 5 methods, but usually based on 11th and 12th class we learn only two methods: straight line method and written down value method. So quoting this example, if a business is following straight line method to calculate depreciation, then this calculation has to be continued on a consistent manner. Year by year the same method should be applied. Then the third is accrual concept. So accrual is something important. Here it is said whatever transactions as already mentioned, agreement between two parties, seller and buyer, regarding business. It's a piece of a business that takes place between the buyer and seller. So accrual says whenever the agreement has been done, whenever the transactions happen, that has to be recorded. Now if I give an example, say for a businessman purchased asset on January 1st, but the payment has been made in the month of March. So when should I record in my book about the date of purchase of asset? Should I record in January 1st when the purchase made, or should I mention the date of, say, for 15th March when I made the actual payment? So here the accrual assumption says when the transactions has been done, agreement done, that means you have taken the asset, that means on January 1st you have to record the date of as a date of purchase of asset, irrespective of the date when you are doing the payment. So accrual says whenever the transaction happens, agreement done, that has to be recorded irrespective when the payment is made. Then next, if you see here, accounting, and this was about the assumptions. So basically we have got three assumptions: going concern, that business is going to sustain for a long time; then consistency assumption, that we're gonna follow any approach on a consistent manner, and the third one is accrual assumption, where you have to understand that whenever the transaction happened, the date, whatever the date is, irrespective of the payment, okay, let the payment be due, no problem, but you have to enter the date as a date of transactions when the actual agreement took place. So this was about the accounting assumptions.